So this week we've had two important events. Firstly, the budget, and secondly, a very strong ADP jobs number in the States. This was the highest in 3 years, and so now, as you can see from this chart, the unemployment rate is well below that long-term average in the US of 6%. We've also seen that core PCE inflation number really rise, and we're now at that 2% target rate for the Fed. So we've seen the biggest mover for markets over the last 2-3 weeks has been a total capitulation from market participants in their view on when interest rates are going to rise. So the probability of 3 rate rises in 2017 has gone from somewhere near 0 in October 16 to 60%, and that's major implications for all asset classes. So the question that we're asking is, should portfolios be more aggressively positioned to benefit from these higher US bond yields? And we've done quite a lot over the last 6 months to position for that. We would say that the sort of essence of or art of portfolio construction is judging the spread of high conviction ideas within a portfolio, not being too exposed to one particular idea. And we've balanced our US exposure between those higher rate plays and the US technology platforms, which are unique, and we have to go to the States to invest in those. Those technology platform names over the longer term have materially boosted performance in portfolios, and following a rotation out of the names, following the Trump victory last year, since December they've again been beating the index, beating the S&P and adding to performance. We feel very comfortable in these names alongside the reflation trades because the PE divergence between this group and the rest of the market has narrowed considerably. So if we look at Alphabet on 16.7 times or Facebook on 17.9 times, 1 year prospective PE against the market of near enough 15, we don't think we're overpaying for that growth rate in any sense. And that's been recognised in the outperformance in the market. Given we are seeing a perfect storm in terms of conditions for higher rates in the US, should we be moving money back onshore following a materially weaker sterling over the last couple of weeks? We're now back towards the lower end of that range, towards the 120 on the dollar. And we're seeing as well a falling policy uncertainty, as evidenced by this Bloomberg chart that tracks policy uncertainty in the UK. That's well off the highs of post-Brexit. So again, we're looking tactically at those names with high correlations to sterling, and sectors with the highest 52-week correlation to GDP euro are insurance, banks, real estate, house builders. In fact, if you look at land securities as a good example of how to play a sort of stabilising, perhaps stronger sterling, that's approaching the lower end of its 30-year relative performance against the old share. So an attractive time to be looking at that sort of stock. Looking at the week ahead, on Tuesday we have Prudential, TPI Cap, Ocado and Volkswagen, and on Thursday we've got Heidelberg Cement as the Killik & Co covered stocks. Thanks very much.